So seasoned investors and advisors, they also ignore the guru forecasts. I found this out earlier in the year, and I brought it up again. This is the outlook for negative returns in the equity markets over the next 12 months. Interest rates are sure to rise soon. China's economy is about to crash. Inflation is coming. Recession is coming in the Eurozone. Possible Middle East conflicts. The market is at all-time highs. Couldn't possibly go any higher, right? The economic data are stalling out. Now, if you have a different belief, you can find somebody else. I found this August 29th, 2014. You can go on the internet any day of the week, find out case for, case against, and they state good cases. This guy said, second quarter economic growth are revised upwards, job growth is improving, jobs that pay higher wages are coming back, natural gas prices are down 20%, globalization is leading to greater prosperity, the digital age is ushering in new innovations, Chinese banks will not collapse, public companies Q2 earnings ahead of expectations. So depending upon what your belief is and what your thinking is, you're going to gravitate towards one or another. The seasoned investor will ignore both of them. They both don't have a clue. They can't predict the future. They're just guessing, and chances are they're paid to guess. That's what they're paid to do. But John, there's another recession coming. I know there's another recession coming. So even if you had this information in advance, you knew for sure tomorrow that another recession was coming, would that help you in any way tell you what the market returns are going to be going forward? Okay, you guys that have been through this class before know it's not going to help you. But those of you that haven't been through this, I'm going to show you right now, it's not going to help you. What if you perfectly could predict recessions? First of all, this is all the recessions and expansions from 1900 to our last one through 2010. That was our last recession in 2009. The blue is the expansions, the red is the recessions. First of all, is there more blue than red? Yeah. So there's obviously more growth throughout the world over history. It just keeps growing and growing and growing because of all kinds of reasons, mutating technology and an expanding population. So the red ones here, another observation is this is our last recession. Doesn't even come close to some of the doozies that we've had in the past. Now granted, it was a tough one, very tough one. Okay, here are all the negative years from 1900 to 2009, all the negative years. And these are the stock market returns. Again, this is 100% stocks. The blue is positive returns during the recession. The red is negative returns during the recession. Is there more blue or red? More blue, right? So there are more positive returns during recessions than negative returns during recessions. Even if you knew a recession was coming, you wouldn't know if it's going to be positive or negative. Now, at the start, it might go down at the beginning, but what happens is the news is not as bad as expected. So all of a sudden, it turns around in an instant. Okay, it's fascinating. Now, I shouldn't have to tell you that it can go down during recession because there are red arrows here, right? I'm not saying that it can't go down. But if it does, then we rebalance into the stocks during this time period. Here's an example of that. 1980, inflation was at 11%. Gas lines, unemployment at 7.5%. We had our president telling us, instead of creating more energy, telling us to put on sweaters. All right? So how'd the market do? Well, going into 1980, 1977 wasn't too good, minus 7.18. And then 1978 plus 6.57, 1979 plus 18, 1980 plus 32. In 1980, when things didn't look so good. Now, part of it might have been that, you know, Ronald Reagan they were thinking he's coming into office, going to change a bunch of things. The first couple of years of his presidency weren't too good, but then it started taking off. So during recessionary times, you can have decent returns. Markets are forward-looking. Expectations about the future are in today's prices. Market returns are not strongly correlated with macroeconomic variables such as GDP, just like that chart I showed you. Markets can provide positive returns in even periods of poor economic performance, and these factors and other variables make market timing extremely difficult, if not impossible. Can stock markets go up in a bad economy? Sure, all it takes is better than expected news. Can the stock markets go down in a good economy? Yes, they can. All it takes is worse than expected news. And that's why the unseasoned investor, when they chase hot markets, they think, I got the all clear sign, right? The economy's good, jobs are being created, I'm going to get in. And all of a sudden, it backs off a little bit, and the markets go down during a good economy. And they get caught in that trap, in that cycle. So good economy or bad economy, it tells you little about the directions of the markets. So if you're prudently invested in a broadly diversified portfolio all around the world, in a portfolio that's for you, in the right volatility levels, because all of you can have different levels of volatility in your portfolio. Some have very low risk and low volatility, some have higher risk and higher volatility. But if you have that, and you're broadly diversified, should good headlines or bad headlines or a good economy or bad economy change your strategy in any way? No. It shouldn't.